Okay, quick rant on the Fed. Sounds like the ball is rolling downhill towards a July or September rate hike. Waller, the whole speech wasn't as hawkish as the headline suggested, but the one headline he gave us was pretty hawkish, basically saying if we get one more bad, core inflation print, he's ready to tighten. This is an asinine way to run policy. And, core PCE inflation has been elevated this year. But if you look at core CPI, it's basically been 0.2 for the last 6 months. There was 1.3 in there, and then there was 1.4 in there, which was distorted because it was April 6 months from the October shutdown that screwed up the OER calculation. That would have been about 0.2 something otherwise. So it's not that bad. And here's the problem with these guys. As I said in a video a couple weeks ago, there's two arguments for tightening, one reasonable, one not. The reasonable argument is, nominal growth's been steady at 5.3 for 3 years now, but we think we've gotten in an accommodated position. The economy is accelerating. Nominal's going to go to 6. Then we'll have to crush things. We don't want that, so we need to recalibrate. And not my forecast, but if that's your forecast, I'm happy to have a discussion about it. It's a reasonable argument to make. But that's not the argument they're making. They're not saying they need to tighten because nominal growth is accelerating. They're saying they need to tighten because inflation has been too high for too long. They're worried about their credibility or whatever. Stupid. So if you look at nominal growth for 3 years, rock steady, 5.3%. Unfortunately, we have had a number of supply shocks in the last 18 months or so. So the real component of that 5.3 is declining and the inflation component is increasing. So this is why we, at present, in the wake of a big supply shock, have core inflation a little bit above 3. But they're arguing, well, you get a couple supply shocks, maybe it's a pattern. We're going to have continued supply shocks. Even if that were the case, it's still a mistake to tighten. Because if we get continued supply shocks, well, maybe real potential is not going from 2 to 3, it's going from 2 to 1.5. And then our 5% nominal is going to give us 3.5 inflation. Yeah, it's a problem for an inflation targeting central bank. The problem is to get inflation down to 2 in that scenario, you need to push nominal from 5 to 3.5. Good effing luck, because all financial market assets are priced off of expectations of 5 nominal as far as the eye can see. Once the market picks up, they want to push it to sub 4. Earnings expectations have to get marked down. Risk assets sell off. Credit spreads widen. There are already concerns about sustainability of the growth of AI CapEx. Widening credit spreads, those get much worse. Risk assets go down some more. Credit spreads widen some more. We've all seen this movie too many times. So this is a big mistake they're potentially making. Let's hope they get bailed out by CPI tomorrow. If not, watch out for risk assets, because the Fed is about to make the classic blunder of exacerbating a supply shock with a demand shock, the ramifications of which are pretty dire for real economic output. They're about to unleash a risk asset doom loop if they continue on this path.